What's up everyone, and welcome to Jayconomics. My name is Jay and it's a pleasure to meet all of you. On this channel, we take a look at anything related to finance with a strong focus on investing. So if that sounds like something you want to be a part of, then please consider subscribing and liking this video to help me on my quest to befriend the big, bad YouTube algorithm. Top 3 growth stocks for September 2020. The stock market right now is on a roll, and there are so many new, innovative, interesting growth companies to put your money into. Last month, I gave you my top 3, and we will review how those stocks performed over the last month in just a second. And after that, we will go over my top 3 for this month that I think are in a fantastic spot to bring exponential gains to your portfolio over the long term. Now, for the purpose of this video, I am not covering companies like Shell or Hyliion and Workhorse, as if you've been a subscriber of mine, you know that I love Hyliion and I do believe in Workhorse long term as well. If you want to see a full update and analysis video, then check out this video linked above for Hyliion. Also, before we start, just wanted to say a big thank you to all of the Jayconomics family. We've grown so quickly, over 2,000 subscribers now, and I'm just very humbled and grateful for your support. So make that thumbs up turn blue and subscribe if you're new. It really helps the channel grow. And now without further ado, let's get into the picks. Alright, our 3 picks from last month were Envision Solar, CleanSpark, and Lemonade. I recommended Envision at $14.23, and today we're sitting at $13.20 per share, and nothing has come up to change my thesis on the company. This is a small cap stock and it will be volatile, so as I mentioned back in that video, make sure to do your research before, and also have a 5-year time horizon for this. I was able to scoop up a 100 warrants at $5.69, and I'm very happy with that position sizing for now. Next was CleanSpark, and I recommended CleanSpark to my viewers at $6.99 per share. Friday it closed at $9.48 per share, representing a 35% increase over that time period. The crazy part is that CleanSpark actually reached a high of almost $13.50 per share at one point, and I'm confident that we will get back into that range sooner rather than later. I have averaged up not once but twice into CleanSpark, as I feel it will pay off in the long run. As I mentioned with Envision, CleanSpark is also a tiny company compared to where I think it will be one day, so be prepared for volatility, but also immense gains. My last pick for last month was Lemonade, and I recommended Lemonade as a 5 to 10 year play at $58.18. And incredibly, this stock actually closed on Friday at that exact same number of $58.18. Now, if my thesis changes for any one of these companies, I will be sure to update my subscribers on this. But for now, I am not worried at all about short-term fluctuations. Alright, so let's get into our top 3 for September. My first growth stock for you today is Docebo. Ticker symbol DCBO on the TSX for Canadians, and ticker DCBOF for Americans, as it does trade over the counter. Docebo provides cloud-based learning platforms to train employees, partners, and customers. Docebo clients are spread across the globe, including North America, Europe, and the Asia-Pacific region. Docebo's learning platform is powered by artificial intelligence to improve the overall learner experience by providing a customized experience to each user. The platform also helps customers to centralize, manage, and organize all learning activities to help enrich the experience. Docebo IPO'd at $16 Canadian per share in October 2019, and after a sluggish start in the market, it picked up some steam all the way to their March lows, and then went down to $10 Canadian. Since then, however, Docebo has been on an absolute tear, going almost 6x in the last 6 months at its highs of $58 Canadian. As of Friday's close, Docebo was trading at $48 per share Canadian and $37 per share USD per share. So, From the IPO date, early investors have seen their investment triple already in less than a year. Docebo's learning platform is now used by more than 6 million users at 2,000 plus organizations in over 68 countries. Docebo differentiates itself because it gamifies learning and allows users to share their knowledge by uploading content. Now, this could be as simple as an employee figuring out a way to complete a task more efficiently. Well, that employee can then go film themselves performing that task and uploading it onto the platform for others to see. Essentially, it's kind of like an open hub for learning, kind of like how a portion of YouTube is also like that. Be honest, how many times have you YouTubed how to do something? Yeah, I thought so. So rather than an old school instructor to learner environment, it also turns into a type of learner to learner environment, which is completely invaluable in my opinion. Okay, let's take a look at their financials. So Docebo's growth has been significant and consistent. They have managed to grow their revenues year over year at a rate of over 50%. Docebo is not only increasing the revenue by adding new customers, they are also upselling their current customers on additional services throughout the lifetime of that customer. If we look at the balance sheet, they have a current ratio, which is current assets over current liabilities, of 1.75, which means that they are in no danger of going under anytime soon. This will allow them to continue operating regardless of future losses they may experience. As part of those current assets, they also have enough cash on hand to cover these current liabilities. Now that's something that I love to see. In terms of the industry Docebo is in, I strongly believe that companies will continue to adapt a work-from-home approach, and because of this, a great LMS system will become necessary for these companies. Another bullish point for me is the fact that this company is a Canadian tech company, and for a long time, Canada has been lagging hard in this sector. In the last few years, we've seen several Canadian tech companies pop off, like Kinaxis, and of course the big one that you guys all know, Shopify. And due to this movement, I see a company like Docebo being a hot buy in the Canadian market for years to come as investors look at solid growth opportunities to replicate Shopify's success. Of course, this is a long-term investment, and this company just IPO'd late last year, so in the short term, you could very well expect this stock to be volatile. One more thing to mention is that they announced on August 27th that they had successfully completed the offering of 1.5 million common shares at a price of $50 per share for aggregate gross proceeds of $75 million. Because of this dilution here, I would be on the lookout for price movement early this week. Now, once I have an idea of where the price is going, I will be looking to start a position in Docebo, hopefully this week. I'm looking for the $45 Canadian range. My second pick for this month is a player in the e-commerce space in Southeast Asia, and that company is Sea. It was founded in 2009 as an online gaming company and didn't jump into e-commerce until 2015 when it launched its Shopee platform, which we will get into in just a second. So Sea operates 3 different businesses: e-commerce, mobile gaming, and fintech. But the biggest and most compelling, in my opinion, is their e-commerce platform called Shopee. Shopee differentiates itself from other e-commerce stocks like Shopify and newly IPO'd BigCommerce in 2 big ways. Firstly, they are not targeting the North American market. They are targeting the Southeast Asian market, which includes countries like Indonesia, Vietnam, Thailand, Malaysia, and Singapore, to name a few. Secondly, their business model is more similar to that of Amazon, Alibaba, and Mercado Libre rather than Shopify and BigCommerce. Now, I lived in Vietnam for 2 years, and Shopee is big. All of my local friends over there used Shopee regularly when looking to buy something online. Shopee was everywhere. You turn on the TV, Shopee commercial. Watch videos on YouTube, Shopee ads. And here's an idea of what I mean.
Shopee? Cùng Shopee,
Nào ta mua
thì cùng có mua hết ở Shopee. Shopee 9 tháng 9 ngày siêu mua sắm, miễn phí vận chuyển từ $0.
Xin cổ vũ mua hết.
Shopee, Shopee. Oh, it's over. All right. Yeah, so imagine hearing that 20 times a day. Yeah. And their marketing techniques have definitely worked. And so needless to say, I saw firsthand just how popular Shopee was over there. And we'll touch on this later, but the stats do back this up. Another reason why I really like Shopee is because they're in a part of the world where they simply do not have the same levels of e-commerce dependency as we do in North America. As Vietnam's economy, as well as the whole Southeast Asian economy, continues to grow quickly, this will give room for higher potential growth than companies like Amazon and Alibaba, both of which are valued at trillions of dollars, whereas Sea's market cap is currently just $75 billion. At $75 billion, this is by no means a small company, but when compared to its peers, there is lots of opportunity. And the main reason why I prefer this stock to, say, Mercado Libre for the South American market, or even Jumia for the African market, is simply because I've seen this all firsthand, and understand the culture and business a lot better due to this. C is also well diversified, and we'll touch on the other two business segments shortly. Shopee, of course, has competition, some smaller national companies in each Southeast Asian country, and their largest competitor, Lazada, which is actually Alibaba owned. Now, Lazada was the leader until Shopee came thundering in. If we look at this graph over here, we can see that, as I mentioned before, Shopee has been the established leader in Vietnam for a while. However, it has made massive strides since the beginning of 2019, and it was able to jump from the number 3 spot in Q1 of 2019 in both Indonesia and Singapore to first place, which clearly shows that it is a quality service that people in Southeast Asia are starting to love. By the way, Indonesia happens to be the largest opportunity in this continent, so this is a big thing. Now let's talk about C's other business segments. Their second business is their e-gaming platform, Garena. Now, a large chunk of their success with Garena came from their hit game Free Fire, a mobile game comparable to Fortnite that monetizes its free game through in-game purchases and monthly subscriptions, just like Fortnite does. Free Fire achieved a new record high of over 100 million peak daily active users. Free Fire was the highest grossing mobile game in Latin America and in Southeast Asia, and ranked third globally by downloads in the mobile games category in Q2 2020. What I can also tell you from firsthand experience is that mobile gaming is huge in Southeast Asia, and should continue to see massive growth in the next 5 to 10 years. That being said, creating another hit game is obviously not a guarantee, and so this revenue stream could decrease, of course. It's not as reliable. This is why C is focusing its attention on Shopee and its newer third business segment, C Money. Now, C Money is still very young, as it was rolled out in late 2019. Essentially, C Money is their fintech platform. Think their version of Square or PayPal. Companies that are obviously growing tremendously through the illness right now. And more people will turn to cashless, contactless payment solutions, and C is looking to capitalize on this. Now, their market cap of $75 billion is obviously not much for a company that is essentially the Amazon of Southeast Asia. The business has more than 4x'd since the beginning of 2020 and has been a major beneficiary of the pandemic. C saw their total revenues increase 102% year over year. Now, having done this research on C and adding to that my real-life experience, I now love the company even more. They are well diversified in 3 sectors that are poised to see extremely high growth in the next 5 to 10 years, and are in a geographical market that is growing aggressively and is still untapped compared to its potential. If you are trying to become a $1 trillion company, then you must diversify and have multiple high-return business segments, like Amazon eventually adopted, and C has done this. Now, in terms of what I'm doing, I just opened up a position in C today and will be adding to my position as time goes on. I will especially go heavy if we ever see the $120 to $130 range again. Last but not least, we have my favorite stock right now, which is Cloudmd. Now, I recommended this company a few weeks ago at 84 cents Canadian. Cloudmd, ticker symbol DOC on the TSX, and ticker symbol DOCRF over the counter for my American viewers. And since I made that video, Cloudmd has gone crazy. It's up 62% since then, closing on Friday at $1.36 Canadian. And I still think it's very undervalued, and I will continue to buy more Cloudmd shares and warrants as I'm extremely bullish on this telehealth company. I'll do a brief overview of the company now, but if you want a full analysis of the company, please check out my other video on Cloudmd, linked above and in the description below. Cloudmd has done some real aggressive growth over the last little while, and the market has been slow to react to this company. Cloudmd provides service to a combined ecosystem of 376 clinics over 8 Canadian provinces, and also their first US clinic in Mississippi, which they acquired earlier this month. They also have over 3,000 licensed practitioners and almost 3 million patient charts. Cloudmd has a hybrid business model that includes clinics, telemedicine, and software as a service. This is all combined together to form a patient-centric ecosystem. Now, if we look at the chart below comparing all of the telehealth companies in North America, Cloudmd has the fastest expected revenue growth at 101% versus an average of 31%. Part of the reason is that revenue is launching off of a small base, but the company also compares favorably if we look at enterprise value over revenue, trading at much lower multiples than its peers. So, fastest growing, cheapest valuation. Where do I sign up? As patients get used to the ease of telemedicine, pundits believe they will initiate more sessions with doctors than they otherwise would. Also, patients who rarely, if ever, seek medical advice or treatment due to a fear of doctors or hospitals, germs, or social anxiety might find telemedicine quite appealing. Doctors like telemedicine. People like telemedicine. The governments like telemedicine. Everyone benefits from this. Point being, telemedicine is hot and is also here to stay. The management team for this company is also very strong and is actually led by doctors. It's been over 2 years that management has seen virtual meetings as the wave of the future. CEO Dr. Hamza has been practicing telemedicine for 7 years, making him a leading expert in this field. Finally, what has happened recently to make the stock go bananas? Well, I think it's a combination of a few things. Now, people are becoming more aware that this hidden gem of a stock actually exists. 2, FOMO, right, the fear of missing out. And 3, lots of great news coming out with Cloudmd having multiple acquisitions just this month. Since I put out my last video on Cloudmd, they entered into a binding agreement to acquire Refunction Health Group Inc., a leading rehabilitation clinic network with 7 clinics and 35 specialists and allied health professionals across British Columbia. This acquisition represents a significant addition to the depth and spectrum of healthcare services provided by the Cloudmd platform. This clinic group is actually cash flow positive with $5.8 million in annual revenue and EBITDA margins north of 19%. So needless to say, this is a great acquisition for Cloudmd. Now, Cloudmd has a bright future, and I think this is easily a 10x stock over the next 5 to 10 years. I own 1,850 shares of this tiny Canadian company at 85 cents Canadian in my tax-free account, and another 225 shares in my personal account. And I'm strongly considering buying even more. On top of my shares, I also own 7,000 Cloudmd warrants at 30 cents Canadian, and I'm up 68% on that position already in a matter of weeks. These warrants have an exercise price of $1 and expire in 2022. So that means that up until 2022, I have the option, but not the obligation to exercise these 7,000 warrants and trade them for shares worth $1.30 each. This comes in really handy, especially if my thesis on this company plays out like I think it will. Now, if you're not too sure how warrants actually work and you want to learn what they are, check out my in-depth warrants video right here. Okay, final thoughts. So I think these stocks have the potential to make you a lot of money if you have the stomach and the patience to handle the volatility. Now remember, I said this last month and I'll say it again, you could have bought Tesla at the same price in 2014 as you could have in 2019. But once it's ready to pop, you can just watch it fly. I hope you guys got some good insight into these 3 high growth companies, as well as a little bit of my mindset as an investor. Now don't forget to do your own research into these companies before investing into them, because you should always know what you own. And guys, if this video brought you some value, then please make that like button turn blue. It really does help the channel a lot. And don't be shy to leave a comment below. Tell me if you're interested in investing into any of these companies, or if you already have invested in them. Also, if you want more content like this, I got plenty more coming your way, so please subscribe and turn on that notification bell so that you're notified when any of my videos come out. Alright, that wraps it up for today. Thank you all for watching until the end, and let's grow this community together. Until next time, take care and invest smart.